Welcome to Not Milk Never Milk. Subscribe if you're lactose intolerant.
In this video, I will explain accounting ratios. We'll start by understanding why these ratios are crucial for analyzing a business's financial health. You'll learn how to categorize them into key groups like liquidity and profitability. It's essential to grasp their purpose, as this forms the foundation for deeper financial understanding. We'll also touch upon the importance of comparing these figures over different periods and against industry standards for meaningful insights. Let's dive into the four main categories of accounting ratios. Liquidity ratios, like the current ratio, show if a company can cover its immediate debts. Solvency ratios, such as debt to equity, reveal long-term financial stability. Activity ratios, including inventory turnover, measure how efficiently assets are used. Finally, profitability ratios, like gross profit margin, tell us how well a company generates earnings from its operations. Each category offers unique insights. Now, let's look at calculating some common ratios. For the current ratio, you simply divide current assets by current liabilities. The debt-to-equity ratio is found by dividing total debt by shareholder equity. To get inventory turnover, divide cost of goods sold by average inventory. And for gross profit margin, divide gross profit by revenue, then multiply by 100 to express it as a percentage. These calculations are fundamental. To truly master accounting ratios, consistent practice is key. Work through various financial statements and real-world scenarios to solidify your understanding. Consider making flashcards for each formula and its interpretation. This aids memorization. Most importantly, focus on understanding the why behind each ratio, not just the calculation. Also, be aware of the limitations and potential pitfalls of relying solely on ratio analysis for decision-making. Keep practicing.
Thanks for watching. If this was helpful, leave a like and consider subscribing. See you next time.